Shares of the Quicken Loans parent Rocket Companies are down sharply. You can see over 10% this morning. This after reporting its first results as a public company. Rocket Company CEO Jay Farner joins us now. And Jay, I have to say, in my experience, seeing a newly public company print $3.5 billion in net income is rare to say the least. Nonetheless, at least at this point, investors don't seem particularly taken with it. Any idea in your part as to why the stock is looking down 10%?
Well, thanks for having me this morning. And I'll tell you, our focus has really been where the stock price has gone since the IPO here just a few short weeks ago. So we're up pretty substantially. And Q2 was a great quarter, and Q3 we think will be even better. So, you can probably help me understand the day-to-day trading of the stock better than I can help you. But the long term is where we'll continue to stay focused on.
I know you are. And to your point, the stock did perform extremely well right after the IPO and the sort of those days and weeks following. And it may simply be the weaknesses based on how much strength there's been to date. Again, because you point out your volumes were enormous, they're going to stay there. I mean, how long can we expect, Jay, to have a mortgage market like the one we're in right now, which we report on every day in terms of housing being so hot?
Yeah, great question. As we talked about the third quarter, our expectations that we'll see continued growth. We're hearing that we're going to see interest rates low for quite some time. And when we think about demand right now, the demand for refinancing and purchase, third quarter will probably be one of the best quarters we've had, remains strong. So really our mission right now is to continue to grow capacity. We're up to over 100,000 clients closed in a month, and our goal is to get to 40 billion a month closed by the end of the year. So the future looks very bright, and for us it's about that platform, about growing out that technology and continuing to take care of our clients with world-class service.
You're certainly optimistic, Jay, but in terms of your commentary suggesting that volumes may follow a more seasonal pattern, that there may be some seasonality, which is typically weaker in fiscal fourth quarter, how much of that is just being conservative, considering the high volumes that we've had, and maybe your expectation that there is some pull forward of housing plus the seasonality factor?
Well, actually, I think that the purchase is going to be remaining stronger through the end of this year. We've seen that so far, and we're looking for inventory to increase a bit. And I think our comments were really more reflective of the natural cycles that we see year in and year out, especially between Christmas and New Year. But as you know, with interest rates the way they are today and the 30-year fixed in the threes, people will be refinancing their homes regardless of the time of the year. And that's going to mean for a great third quarter and a strong finish to the year.
Speaking of which, Jay, I wonder, there's a view on the street among some who are watching the banks that the bulk of loss reserves for the year is either close to being over or may already be over if you are convinced that macro strength is returning. You got any color on that?
No, I don't have a lot of color on how the banks are performing from a loss perspective or their reserves. I can tell you from our perspective, we watch forbearances very closely, of course, as one of the largest servicers in the country. And we're actually seeing our forbearance rate continue to drop, which I think is great news. I saw you reporting jobless claims as well. So I think overall, a real positive feeling that banks, companies are positioned well, and there's a lot of bright side or upside that we're going to experience as we get into the second half of this year.
How have your lending standards been, Jay, compared to, say, 6 months ago or a year ago? And I'm wondering if there's any sort of opacity in the amount of data that you have. What struck me was that there was a comment about a month ago from the Capital One Financial CEO saying that they don't have a really rigorous handle on the level of unemployment amongst their borrowers, that it's just unclear that many people are at certain levels of unemployment. You mentioned forbearances. Forbearances don't get reflected in credit score. So I'm wondering how you adjust for these things that may not have existed before.
Yeah, great question. So the lending standards are the same as they've been. In fact, in a few areas, a bit tighter than they were 6 months ago. And so we feel great about the credit quality that we're seeing, the income quality, and the loan to value on mortgages as we've seen property values continue to increase. And as I mentioned, from a forbearance perspective, I think this reflects the servicing approach that we take, proactively reaching out to our clients, ensuring that there's somebody there to pick up the telephone, take their call or their email. And in talking with our clients, our book looks in some very good shape. So I think with the credit that the criteria that's being used today, the mortgage industry is in a nice spot right now.